Hi, I'm Peter Switzer. Australia makes up less than 2% of global markets, which means over 98% of all listed investment opportunities are located outside of Australia. Additionally, the Australian market is dominated by financial and resource stocks. Conversely, IT stocks make up 22.5% of the US market compared to just 1.2% in Australia. Our market simply doesn't have the Apples, the Amazons, and the Facebooks. Today, we're joined by Paul Black, a leading fund manager from Laguna Beach, California. Paul has teamed up with Contango Asset Management to launch Contango Global Growth, a new listed investment company that invests in a diversified portfolio of global equities. Well, welcome, Paul, to Australia.
Thank you very much.
So you're here for the Contango Global Growth Fund launch. You come from a company called WC Investment Management, and together you guys are going to create this fund. Mm-hmm. Tell us about WCM.
Well, WCM is an institutional global growth manager, actually based in Laguna Beach, California. We've specialized in running global portfolios for about 11 years. And we're a very boutique, small firm, 38 people, but we've worked exclusively with institutional clients in the U.S. and also down here in Australia. This is our first foray into the retail market.
So you've worked with some of the big and well-known Australian super funds.
Yes, we do.
Have you learnt things about Australians as a consequence of doing that?
They're delightful people. They remind me, actually, we say all the time, every time we've come down, and we've been coming here for 4 years, the Aussies remind us of a lot of Californians. Delightful people. It's been fantastic.
Now, you've had a fantastic track record.
Yes.
So tell us about the existing strategy and what you've been doing for institutional investors. And this is what you are now going to make available to retail investors.
Right. Yeah, the first point that's real important is we've done a really decent job over a long period of time. Over 9 years, we've performed 5% better than the general market, the global markets. But I think more importantly, in tough markets, when markets get really tough, like in 2008 during the financial crisis, we did about 9% better than the market in that period of time. 2010 and 2014, we also did very, very well in difficult markets. So I think what's most important to individuals is not to lose as much as the market when the market's down. So, the numbers work. If you lose less in down markets, you don't have to do as well in up markets. So over time, you get a very good compound rate of return.
Okay. Obviously, people love what you're saying. Can you share with us the investment strategy that explains why you do so well?
Yeah, I think there are a couple of, actually 3 components to it. The first one is that's very, very important is how differently we build these portfolios. They're very different than most of the names that exist in Australia, for instance. We give clients exposure to consumer names, healthcare names, and tech names. And I think why that's very important is because of the rising middle class. I'm sure you've talked a lot on your show about people getting wealthier in different economies, certainly in Brazil and Indonesia and India and China. This is a very good way, owning this portfolio is a very good way to participate in the growth in the middle classes around the globe, because as people get wealthier, they're going to buy the products from the companies that we own. So there's this really nice kind of tailwind that's going to drive this portfolio for a lot of years to come. And then on top of that, you look at, obviously we want to buy high quality businesses that have competitive advantages that are growing, because that's essential. Warren Buffett talked about buying companies with wide moats. We want to buy companies where the moats are actually getting wider, because we found that the stock price will actually track the expansion of that moat. So the more rapidly that moat grows, the better the stock price does. And then I think kind of one of the more interesting aspects of what we do is the emphasis that we place on corporate culture. I think anybody that's lived life for any period of time knows how important a corporate culture is to the long-term success of a business. So if you can find a business where the DNA, the core values of the business are aligned with the competitive advantage, that will go a long way towards allowing that company to prosper for long periods of time. And we like to hold names for long periods of time, 5, 7, 10 years. Because that's really where you can exploit inefficiencies in the market.
Okay. Paul, why don't you also explain what you think your point of difference is to other global fund managers here in Australia? Because ultimately, that becomes your competitive advantage.
Right. I think one of the main differences is how we look at companies. We really are most interested in looking at individual companies on a fundamental basis, one by one, and trying to find the best companies in the world. I know a number of your local managers or other managers around the world kind of start at the top, where they're trying to figure out where interest rates are going, what GDP growth is going to be, what the Fed's going to do, or the capital markets. And from our perspective, that's a very, very tough game to play. You know, if you're going to make predictions about the future, you need to make a lot of them because you're bound to get one right. And from our perspective, it's much safer just to buy high quality. It's very Buffett-esque. Buy those high quality business, give them time to work, give them 5 to 7 years, they'll do well for you. The other side that's very different is we really are truly a global fund. We don't have the vast majority of our assets in the United States. You know, if you had a fund loaded up with U.S. companies over the last 7 years, you did brilliantly well because the U.S. has been a terrific market. It's been the dominant market in the world. But is that going to continue into the future? And we think the probabilities are very low that the U.S. continues to dominate. So we like owning a lot of companies outside the U.S.
And you also talk about something I think is really interesting, downside capture. So explain what you mean by that.
The downside capture essentially means when things get really rocky out there in the markets, and certainly during the global crisis, when things get really rocky, our companies and our portfolio tend to hold up much better. So people don't lose as much money. And again, that's to us the name of the game. The less you lose in difficult times, the less you have to make in very, very good times. So if you can lose less, you know, over the long run, you're going to do really, really well.
Okay, so talk us through some of the holdings in your portfolio. Amazon is one of your top holdings, and you have strong views on some Aussie retailers as well.
Yeah, you know, Amazon, I understand, is coming down here in the next year or so. It's going to be rough on the retailers here in Australia, as it has been in the United States. You know, for the last 100 years, you've had the Sears company, JCPenney, Mervyn's, really big, iconic retailers that are going out of business because of what Amazon's doing. So, I mean, tongue-in-cheek, if you wanted to run a nice portfolio in Australia, I'd probably short the retailers and I'd go long Amazon. It's a devastatingly disruptive company.
And are the companies that you're tracking around the world, do they have characteristics similar to Amazon?
Yeah, there's actually one that is one of my favorite names in the portfolio, and it's one of our top 3 holdings. It's called Mercado Libre. And what we've often said is Mercado Libre is just like Amazon, but it's based in Latin America. So it's an Amazon eBay model with some mobile payments aspects to it. We think Mercado Libre is just like buying Amazon in 2007. So if you think about Amazon in 2007, you're probably up 1,000%. Since then, it's not a bad opportunity.
How do you pick companies like Nokia, that was one of the best companies in the world, obviously with a very good moat at one stage in its life? What happens to a company like that, and how do you pick when that moat is actually getting smaller?
It's a great question. I mean, you know, I've often said that in 2007, if you talk to a bunch of the so-called smart research analysts on Wall Street, they would have all said that Nokia was a very high quality business with a big economic moat, and it was selling at a discount to its value. And of course, they were all wrong. And in hindsight, we realized it really wasn't a high quality business. And the reason it wasn't is because its competitive advantage was actually eroding. Over time, it was losing its competitive advantage to first Apple when they delivered the iPhone, and then the Android system came out, which was absolutely devastating to Nokia because you know, what Android allowed a lot of Asian companies to do is make very cheap phones, which completely undermined what was going on with Nokia. So the handwriting was on the wall pretty easy, and you could have, you know, if you wanted to run a long short portfolio, short Nokia, short RIM, and go long, you know, the companies like Apple and obviously Android.
The last question, and a lot of people watching this program may well be wondering, why Laguna Beach? Like, we all think the hot shots are in Wall Street, maybe Seattle if you're IT or Silicon Valley, but why Laguna Beach?
It's a massive competitive advantage for us, right? There's so much noise in New York and San Francisco and Chicago. You know, Warren Buffett's been very popular, right? He lives in Omaha, which is the middle of nowhere, right? And the beauty of being in Laguna Beach is you're not subject to the constant chatter that goes on, which really forces you to be very short-term in your orientation. You know, to make decisions in 3 and 6 months period of time versus 5 and 7 year periods of time. So we are able to be more thoughtful about the portfolio based in Laguna. It's not a horrible place to live. One day you'll be there.
Yeah. Paul, Great to meet you.
Thank you very much. Nice to meet you, Peter.
That's Paul Black from Contango Global Growth. I'm Peter Switzer. Thanks for joining us.